What's up, guys? Welcome back. It's your friend Nate. I had a thought that went through my mind the other day, and I actually wrote it down. And I noticed that when I'm speaking to people, they'll mention a lot of the similar books, but they usually won't mention more than 3 or 4 books. And you guys all know the books I'm talking about out there. They've been around a long time. They're usually the go-to for investment gurus or whatever. And I've come to the conclusion that there's a very serious problem with reading less than 10 investment books. And I've concluded that reading 2 or 3 investment books can almost be worse than reading no investment books at all. And the reason why I say that is a lot of my own personal experiences going through that exact experience. So one of the first books that I read, I was very impressionable, obviously, and open to the subject, and so I read a lot and really bought in to a lot of that information, as we all do with the first few books we read on a particular subject. And in this specific example, it was talking about modern market theory and the efficient market hypothesis. And so, as I was concluding that book, I came to the conclusion that no matter what you do, you can't outperform the market, because price equals value, and in the informational digital age that we live in, all things are all known all of the time. And so that kept me away from public stock investing, or at least I didn't feel that I would ever be able to do better than average in the stock market. And there's a lot of truth to that, of course, and that's why indexing is so successful. But it eliminated my approach to trying to apply critical thought to the subject because it seemed like it was unwinnable. And so that stopped me from investing in individual public stocks for a long time. I'll also bring up another book I read was, I as many of us do, right? We want to figure out how to invest money. We think we got to figure out the economy. So we read a bunch of books about economics and so forth. And very, very quickly on, right, when you're talking about the history of a lot of countries, you're going to find that we used to have what's called sound money, right? Until 1971, we had the gold standard, and gold used to be money, and how critical of a component sound money has been throughout history to economics and the development of countries over time. And so next thing you know, you're convinced that sound money is the way, right? Next thing you know, you have enormous amounts of wealth tied up in precious metals stuffed away in safety deposit boxes all over the place, and you don't realize the reality of the expense, right, on a monthly basis, that opportunity cost that you're really experiencing there. And so over time, it's important to make sure, as Jim Rohn has said this many, many times, be a student, not a follower. The problem with reading less than 10 investment books is that you haven't come across enough brilliant individual investors who also have different approaches than other brilliant investors. You know, there's macro economists out there, macro investors that outperform the market. There's also individual value investors, right? Individual stock selection. A lot of great value investors out there, macroeconomics and so forth. A lot of great bond investors out there too. So all those different segments have brilliant investors. And you have to find your own approach. There's so many different ways to invest money. And one of those you're going to gravitate towards naturally. Individual stock selecting is not for everybody. And I understand that, right? Because there's a ton of volatility out there. Now, for those of you familiar with volatility, I'll give you a perfect example too. When we talk about, a financial education and reading books, the first books that I read, they describe that risk equaled volatility. Because in the financial industry, they use beta, divergence from the mean, to indicate how risky something is. But when it comes to individual stock picking, if you already know what you're willing to pay for a company, that volatility is your advantage. You get to take advantage of those swings, take advantage of the inefficiencies. And so, also, I've read books about real estate investing as well. And the other thing is, a lot of these best-selling books, they've been around a while, right? You also have to take into context what those general market segments were like at the time the books were written. And one thing I think that the overall investment community doesn't appreciate is what multiple was real estate selling at within the time those books were written. Because don't forget that all investments are just multiples of current cash flows. I'm not saying that you have to pick a specific investment route. I'm just saying, does it really make sense to invest in a specific segment indiscriminately of the price to earnings that you're paying, right? How many multiples of free cash flow are you paying? You don't want to pay too much. And I just feel like right now, a lot of these investment books that are out there, they are not appreciating the awareness level that should be instilled in the typical investor, the successful investor, as far as being aware of how many multiples of free cash flow you're paying today for the investment segment that you're entering in. Just remember that paying too much for a common stock or any investment has the same outcome as purchasing the completely wrong stock or investing in the completely wrong segment. And that's something that Benjamin Graham pointed out throughout his books, which is certainly a critical point to keep in mind when you're starting out your investment journey. You have to understand that an investment is not cheap or expensive based on the price of the actual asset itself. It's expensive or cheap relative to the multiple of current earnings that you're paying. If you're paying a 20 times multiple, you're only making 5% on your money. That sounds expensive to me. Whereas if it's selling for 10 times current cash flow, you're making 10% on your money. So even if you have a $500,000 house, but you're paying a lower multiple, that house is actually cheaper than the house that's $100,000 that you're paying a 20 times multiple on. So keep those things in mind as you all continue to navigate through your personal experience through investment education.